Welcome back to All Things Money. I'm David Blain, and in today's show, we're taking a look at our final segment of the mid-year update. We're taking a look at some of the business sectors of the economy and how they're performing. One of the things that we're ever watchful for currently is this break from the what happens typically after a bear market. We see a large rally, which we had throughout 2009, which seems to have broken down somewhat as here we are in mid-2010. And so some of the indicators we look at, one that we like, we talked in the first segment about the PCE versus CapEx expenditures, and this is a signal for moving from early cycle leadership to later cycle leadership. And there have been, since 1975, there have been 5 important PCE CapEx peaks: 1976, 1980, 83, 92, and most recently in 2003. And what we're looking for here is a peak in the consumer versus CapEx spending. And before these peaks, we see that information technology and consumer discretionary typically do the best before these peaks. After these peaks, we see somewhat of a shift, and we see information technology and consumer discretionary moving down the ranking. We see utilities rise to the top. We see industrials move up, and we see energy move up. And so these are what we would call late cycle plays, meaning after a bear market rally, which we've had, the bear market turning into a bull market. There are certain industries and sectors that typically lead, consumer discretionary being one of them. And then there are certain later cycle plays, things like industrials. And so we look at, when we look at the top performing sectors, IT was up about 22.4% in the pre-peak area. Consumer discretionary up about 18.5%, and industrials up about 16.6%. In the month following these peaks, the sectors get reversed. Industrials leading the way with utilities at about 8.5%. Consumer discretionary and information technology fall off down into the 5% range. So once again, we look for these shifts in, these are not things that happen on a daily basis or a weekly basis, but certainly over a period of several months, we see these shifts in leadership from different sectors of the economy to others. And if you go back in history and study these, you can see that the history of the markets do follow some patterns. Once again, it's not intuitively obvious on a daily or weekly basis, and frankly, it's not always possible to even profit from these cyclical trends. But it's important to know that they're out there and to be aware of them. For sub-industries, we talked about, once again, the beta of the portfolio, meaning how much it goes up or down according to the market. A industry or a company with a beta of greater than 1 will increase at a faster rate than the market when the market goes up, and it will go down at a faster rate than the market when the market goes down. And so some of our companies that we like with a beta of greater than 1 have been the industrial conglomerates and industrial machinery. Sub-industries with a beta of less than 1, we like environmental services and commercial services within the industrial sector. So once again, when we look at the shift in leadership over to industrials, within those sectors there are certain industries that typically lead in the second half of the year. We'll also keep an eye on the railroad stocks in the event that transportation and those type of issues become upgraded. In tech-related sub-industries, we have some industries with a beta greater than 1, like electronic equipment and networking equipment. For less than 1, we prefer IT consulting and services. They're much more recession-proof. And a final note, in the tech industry, we're looking at semiconductors, which we have been overweighting, are likely to underperform in the second half of the year. And so we're looking, currently we still have them in the portfolio, but we're looking to possibly remove them. However, if the second half, a rebound occurs and the downtrend is halted, we may take a look at that semiconductor selection. So to wrap up our discussion on sectors, we anticipate a choppy market environment through the rest of the year, and in fact have moved to a neutral position on our allocation. We're looking at what's called the SHUT index, which is the staples, healthcare, utilities, and telecommunications. These are typically your defensive sectors. We look for those sectors to start to outperform some of the early cycle sectors like consumer discretionary. We also are taking a look at the beta of the portfolios. You want to make sure that now might be a good time to reduce the beta of your portfolio. Once again, we think the easy money coming out of March of 2009, where it was fairly easy to make money in the stock market, we think those days have ended. And so we recommend taking a little bit more neutral approach, lowering the beta of the portfolios. We're taking a look at overall importance of materials and energy, as well as commodity prices, the dollar and China, and things like that. We think that some of these themes will continue into the future. It was a good sign that the Chinese are allowed their currency to float a little bit against the dollar, but there's still a lot of uncertainty in the world economy in the future, and so we're recommending that our clients take a more neutral approach, not overweight equities as much, lower the beta in the portfolios, and we think that will be well positioned for the rest of the year. Well, that brings us to our next break. When we come back, we'll take a look at some of our viewers and listeners' email. For All Things Money, I'm David Blain.